Welcome to the InvestFourMore Real Estate Podcast. My name is Mark Ferguson, and I am your host. I'm an active real estate investor in today's market, having done over 140 flips. I flip from 15 to 30 houses a year. I buy residential and commercial rental properties, and I'm an agent with a team behind me who have sold thousands of houses over the years. So on this show, I talk about myself, my career, and advice, as well as interview other amazing agents, wholesalers, landlords, flippers, and the companies that help those people succeed. So before we get started, if you're interested in help from me, I've got discounts on my coaching products just for podcast listeners. Head over to InvestFourMore.com/discount. That's InvestFourMore, invest, FOURMORE.com/discount. And you'll see coupon codes for my coaching products. I have video training series on flipping, on getting great deals, training for agents, training for rental properties as well. And many of those come with personal coaching from me. So I hope you enjoy it. I hope you enjoy the show, and let's get started. Hey, and we're back with another guest for this week's episode. We have Ray Sturm on, who was the co-founder of Realty Shares, which was a crowdfunding company, and now he's the current founder, CEO of Alphaflow, which is an automated investment fund that uses artificial intelligence. So I'm really excited to talk to Ray, figure out all about that because it's way beyond my scope of knowledge, and see what else is going on in his world. So Ray, thank you so much for being on. How are you?
Hi, Mark. Thanks for having me. Excited to be here. I'm doing great.
Yeah, good. No, I'm happy to have you here. I always love to start just right off the bat, kind of get some background on you a little bit. Can you give us kind of I don't know if it's concise, but of how you got involved in, the real estate world and these companies?
Absolutely. So I started my career in pretty traditional finance. I started out at Ray Sturm, which just went through its 10-year anniversary of its collapse. But I actually started my career there in investment banking and worked through investment banking, worked through restructuring, and then went into private equity as an investor. So very traditional white shoe Wall Street finance. And from there, I started to make my way to the startup world, where I started to see things changing, where the Jobs Act was coming around in 2012. We were starting to see new regulations coming around that were going to make things like crowdfunding possible. And coming from Wall Street, I started to see the differences in sophistication between what we saw there when you were investing billions of dollars for highly sophisticated clients and what most people could get, even what I could do on my own. And so that really brought up the urge to start companies in this space. And given the Jobs Act, the natural question with startups is always, why now? Why does now make sense before any other time? And the Jobs Act really was that catalyst for our whole industry starting. And so 2013, went out and started my first company, Realty Shares. I was the co-founder there, and it was one of really the first 4 real estate crowdfunding platforms that kicked off the industry, and today it's one of the biggest in the country. From there, I left after a few years to start Alphaflow, and it was really thinking about the same asset class, the same group of clients, mostly accredited investors at that point, a handful of institutional investors. But really the idea was people love the product, they love the return, but they wanted something more passive. So between these two companies, if you want to pick your own deals, Realty Shares is a great place to be. If you want something more passive where we build your portfolios for you, Alphaflow is right there, and things are working well. We've been going now for a couple of years at Alphaflow, and both companies are doing great.
Awesome. I might get a little bit off topic here a little bit, just because so many of our guests are investors, people buying apartment buildings, single family homes, or flipping houses, things like that. But then once in a while, we talk to someone like you who's building, big, I don't know if you want to call them huge, but, companies and being a real entrepreneur on that side of it. Can you give us a little bit of insight onto what it's like to start and run a company like Realty Shares or Alphaflow?
Yeah, it can be scary at first. I can tell you the second time you do it, a lot of the scary parts go away. But the first time you do it, you've maybe never rented office space before. You've never hired people. You've never built a team. And really, you've got to convince people that are in jobs that are paying them well to leave those to come work for you. And really, you're selling a dream and a vision. And I think in many ways, it's really exciting. On the other side of things, it becomes all encompassing. People talk about how hard it is in the startup world to get a balanced lifestyle. And I'm just not sure that's possible. If you're truly trying to do something industry changing, and especially if it's an industry like finance and investing that it's full of smart, ambitious, hardworking people, I think it's pretty high ego to think that you can just work smart and not work hard. So it ends up enveloping a lot of your life. And so it's a big commitment you have to make. The flip side of that, and what's kept me in this world, is I haven't found a more fulfilling job. Where I came out of business school and I really wanted to be on Wall Street, and it sounded great to say I was an investment banker, but I wasn't fulfilled there as a career. There's something pretty amazing about walking around an office, building a business that did not exist until you thought of it, especially a new concept that was never there, and that you're building people's careers. And so you need to find something, whether it's the company itself, whether it's the job itself, whether it's the people that you're hiring, but something that really gets you excited. And for me, it's company building. I love finance. I love that I can do it around investing. Our clients are great to interact with, but really the main thing that I focus on is just really building people's careers. And so to me, Mark, that's been a lot of fun. I get to do it in the realm that I find most interesting, which is the finance and investing world. And the other thing that you need to get either really comfortable with or, like me, actually really enjoy is your days are pretty different and unpredictable. So on one day, it could be fighting a legal battle. On another, you're focused on hiring, marketing, growth, fundraising for venture capital, whatever it is. I find that all pretty exciting. So if you're okay with a little bit less of a predictable schedule, but things that stay interesting and pretty intense, starting a company like this could be a great way to move your career along.
Oh, great information. I'm the same way. I can't just sit at my desk and do the same stuff all the time. I have to be either out looking at properties or writing or doing these podcast videos. Like I have to have something different going on all the time. So I understand that viewpoint for sure.
Definitely.
One last question on that. I know it takes an incredible amount of work and dedication to start something like that. I think almost any business or career, really, if you want to be successful in it, you should spend an incredible amount of time and effort in the beginning. Do you ever see a point where it levels out and things get less crazy? Or is it just kind of something where things are always changing and you're always having to work on it and put that time into it?
I think you need to be honest with yourself on what size of company you want to build and the growth trajectory needed to get there. If you're building Airbnb, I'm not sure if you talk to Brian Chesky, if things are less crazy now than they were in their early days. Maybe they're not worried as much about going out of business, but the expectations on a company like that are monumental compared to what they were in the early days. I think one of the challenges of living in San Francisco and Silicon Valley here, working around companies here, is that you get enveloped into this thing that if you don't build $1 billion company, you've failed, which I think is absurd. And so if you really create expectations of what you're trying to build, the size of company, the size of team, if you need billions of users, then your life is going to be crazy for 10, 15 years. If you want to build something that's closer to, some people call it a lifestyle business, which is referred to negatively around here, but that's completely fine. You build a cash flowing business that's great and maybe earns tens of millions a year in revenue, that's fine too, and you might get a little more leveling off at that point. For me personally, what we've started to see is my challenges change. My days are probably just as busy, but over time, the work has gotten more interesting where as we hire a bigger team, as we go further up the growth curve, I'm able to hand off things that might be a little more manual where I know how to do them very well, but the person I'm handing them to is learning a lot by doing that, so they're fulfilled, but I wasn't. And it lets me focus on more strategic items, structuring deals, building new platforms, looking at new investment strategies. So the days stay pretty long and intense, but to me, they've evolved enough where it stays interesting, and I don't necessarily feel burned out because of that.
No, that's awesome. I know we're getting a little bit off topic, but one last thing I wanted to mention was a lot of people who I've read books from or heard from who are, hundreds of millions of dollars in net worth or even billionaires. I feel like a lot of them say, man, I wish I would have quit at 50 million, where I would have, had more of a life and not gone crazy.
Yeah.
I know that's not something a lot of people listening to this can relate to, but still there's something to be said for enjoying what you create in your life and not just working nonstop all the time forever.
Absolutely. It's one of the big things where, as cheesy as some people refer to Tony Robbins, I've really liked one thing that Tony's talked about recently, which is trying to not conflate accomplishment with fulfillment. And so you hit the top of your industry and you're accomplished, but you don't feel good about what you're doing. I think when you stop being fulfilled, you need to pull off the gas. And, there was a company, let me not name it, but recently was sold for in the billions. And you should never feel bad for a founder that runs a company that sells for that amount. They're going to do fine. But the reason this guy sold is, to your point, he was just burned out. He was tired of the fight. And the company could have gotten much bigger, most likely. But it was, it was bought, and he gets to move on with his life and maybe take a big, long, deserved break. So I agree with what you're saying.
Right. All right. Great stuff. Now, moving on to Alphaflow, can you tell us a little more about it? What you do, how it works, and what the concept is behind it?
Absolutely. So just to level set, our main focus is on real estate bridge loans. And so listening to your podcast, it sounds like you've talked about fix and flips a lot. And so what we focus on is the loans taken out by flippers often. So real estate bridge loans, residential focus, typically 8 to 12 months duration. So these are pretty short-term loans, and they cost between 8 and 12% to the borrower, something like that, depending on where you are in the country. And at my first company, Realty Shares, we would originate these loans. We would actually make these loans. And what we started to see as another opportunity, and what Alphaflow really grew from, was saying that there are a lot of lenders. There are thousands of these, actually small, hyper-local lenders around the country. They know their neighborhoods very well. They know their markets, and they're making loans, and there isn't really a secondary market for what they're doing, and they're always capital constrained. So they've got a limited amount of capital, maybe some of these as small as $10 million, and once they loan out that $10 million, they can't make any more loans. And these are really interesting asset classes. They've sort of stayed off the radar because this industry is a little too fragmented. And so what we've done at Alphaflow is we've started to tie together those lenders. So we don't originate the loans, but what I do is I partner with these lenders. I review their loans, and if there are loans I like, which we're pretty picky these days, but the loans we like, our investment team will purchase those loans from them. And we've got a huge inventory of these loans at this point. And what we do for our clients who, again, they're accredited investors primarily, and so think doctors, lawyers, white-collar jobs typically. These clients come to us. All they do is they make a single investment. We've got a pretty low threshold, $10,000 to start out, but people tend to grow from there pretty quickly. And what we do is we build a portfolio. So it's not a pooled system like a fund where you think you're in everything in the fund. If you were to come on, Mark, we'd basically look at the last 90 days of loans we've bought, and we build you a portfolio of probably 80 to 90 different loans in give or take 15 to 25 states around the country. So you're getting a lot of diversification. Every loan has gone through our underwriting, which is pretty harsh. These days we reject about 92% of loans we review. So we've got a pretty high bar for those loans. And people tend to earn between 8 to 10% is what we say that our target goal is there. And that's basically how it works. For the investor, extremely passive. You get a diversified product. You're paying a 1% fee on your assets under management. For us, we're out there partnering with lenders, buying the loans that we think are the best ones, and using those to build portfolios for our clients.
Awesome. It's funny because I haven't done many hard money loans myself. I've flipped 26 houses last year. I've used mostly private money, some bank money, but I used a couple hard money loans lately, and one of them got sold to another bank or fund. And I'd never seen that before because, like you said, there was never a secondary market for it. And I was really surprised when I saw all of a sudden I got a letter saying, hey, your loan has been sold to us. Please make payments to us now. I'm like, oh, wow. They do that all the time with typical, conventional FHA loans, but not with hard money. So I don't know who bought it. I don't remember the company's name, but maybe it was you guys. Who knows?
Yeah, you never know. Yeah, and a lot of us end up using servicers that are probably sending you that letter. So that's not us, but FCI or someone like that might be servicing that loan for us. But I think you're going to see it happening more commonly. I think we're a little bit ahead of the curve here on this. And it's only because I was there in the first days at Realty Shares. I saw the limits of what that system could do and really built what I think is the next generation of this sort of investing.
No, that's a really interesting concept. And yeah, I wonder with buying those hard money loans, you said you reject 92% of them. What are some of the criteria you use to pick the good ones? Is it like based on the profit margins or the borrower, or how do you pick those?
Yeah, it's a pretty intense process. And so some of it is standard underwriting, and this is where the AI starts to kick in as well. And it sounds one of these futuristic terms, artificial intelligence, but it's got real applications in this space. So at the most basic level, we've got a credit box where we're not looking at certain loans, where we're not going to look at a loan that's over 80% loan to value, which in this industry, people have moved that up a lot. And we're looking at that on origination. So if someone's into a house and they're buying it on purchase and one of these lenders wants to give them 100% financing at purchase, that's just not a loan for us. We've figured out that the defaults on those are much higher than otherwise, even if it's a trustworthy, experienced borrower. And so from there, we're doing an analysis really pretty in-depth, and we're using a system that we built ourselves. The lenders tend to send us a lot of information, but the reality is we weren't getting all the information we wanted. And so we built a data analytics platform basically from scratch, partnered with a company called The Number out of New York to power that credit model. And what we're doing is for any given loan we're looking at, we're pulling a lot of information on the property, on the market itself, and then, of course, on the borrower. And so for each of those on the property, we're doing things like you said. We're looking at the margins. We're looking at the scope of work. How big of a change is this? Are they trying to triple the value of the home? Are they trying to increase it by 50%? those things really start to impact default rates and success rates if you actually run the numbers. I'd argue that we've got, if not the biggest, we've probably got a top 3 data set in the country right now of all fix and flip loans, which gives you a pretty big edge in seeing what's actually worked around the country and what hasn't. When you think about the market, you need to stress test this, and you need to say, like I said, I came from Bear Stearns, so I've got it in my head. I was there the day that the bank basically collapsed, and that doesn't leave you that experience. And so what we look at for every single loan we do is we stress test it. We say, in the last 30 years, what is the worst dive this zip code has taken? What is the worst? And for most of them, it's around 2008, but some of them, it's other periods. And we basically adjust our loan to value and say, okay, if that happened again, would we still be in the green? Are we in the black, or are we in the red at that point? Like, are we looking good? Are we break even? Or are we basically at a point where we're losing money if that happens again? If we're in the red, we're looking at this a lot tougher. We need to take a deeper dive. It's not an automatic nix because that's the worst in the last 30 years, but the rest of the deal needs to really make sense. And then when you start to think about the borrower, we really don't do a whole lot with first-time borrowers. And one challenge here, Mark, I looked, Rutherford's done great. It's got a lot of experience. I think you said you like doing 10 to 20 deals a year, right? So when you guys are doing a deal and let's say a retaining wall falls over, you know how to deal with that. That's experience you have. You have the right subcontractors that can come in and handle that, if not even on your own team. You know the permits that are needed. First timers, it's great people are getting into this space, but the reality is you're going to learn a lot on your first few flips. And you're going to learn those typically when things go wrong. And we don't always want to be the lender in that scenario. So we tend to cancel those out. What we've done is basically created within there's a little bit of secret sauce, so I won't share too much, but we've figured out which things overlap between experience, the market, and the property itself to create, I think, an industry-leading delinquency rate where it's extremely low. It's about 10% of what we've seen around the industry. The reality is we're not going to do a lot of the 12 to 14% loans that might get people interested, but we're also going to avoid a lot of those defaults. We're not hyper-local. We're around the country, so we're not eager to go and repossess houses. We want to work with borrowers that can repay, that we can repeatedly work with again and again, and really build a relationship so that when they're going to their lender and their lender's calling us, they know they've got a buyer for their loan, so they're more likely to do loans for that borrower, and that's a good relationship for everybody.
Oh, great information. And I don't know if you can share this or you want to, but something I was thinking about while you're saying that is you're collecting all this data to figure out what the best loans are on the best properties. That would be really useful information for people who are flipping or looking to flip.
Yeah.
I think just to see, like, if you took all that data and had an average, like, this is the best, loan to value ratio we see. This is the best profit margin we see. These are the amount of repairs that usually work well. That would be incredible information for people who are flipping houses to see, hey, maybe you shouldn't do a $150,000 rehab, right? Because 50% of the time you don't make as much money as you thought, or something like that.
Yeah, we thought about better ways to partner all the way with borrowers. And at this point, we're partnering more with lenders, but if we can create relationships all the way through and really benefit borrowers, that helps us at the end get better loans too. So I think you'll see something like that down the line. It's not in the immediate roadmap, but absolutely. If we've got this information, we should be doing a better job of getting it out there and helping people.
Can you give me just a few tidbits? Like, do you see, like, what is one of the things you see creates major delinquencies or problems besides like the first time flippers?
Sure. Maybe something more for a lender than for a flipper, but we've stayed away almost exclusively from cash out refinances where you come and you say, hey, I've got a house, it's got no debt on it. I want to pull the cash out so I can go buy another property. The DQ rates on those are significantly higher than an acquisition loan. And there are obvious reasons for that. First, if you're doing an acquisition, you're getting a market clearing price, so you feel better about the value against which you're loaning money. The second is the borrower is putting money into this project, and that means two things. One, he or she is in a good position because there's actual cash that they're able to supply. And the other is, of course, that they've got more skin in the game. Whereas if you're just cashing out, you never know. We've seen cases where we passed on these loans, but that cash ultimately was used to pay off credit card debt, a family crisis, all sorts of things that are fair, but we might not necessarily want to be the lender in that scenario. So that's one little tip that we've seen decrease our default rate pretty significantly, avoiding those.
No, that makes sense. I would say too that if you're doing a cash out with a hard money loan, it might indicate if you were doing a flip, you ran into problems with that flip. Like it took longer or you had major repairs or something that you didn't know about, which could cause higher defaults too.
Absolutely. What surprised us is all of those things should be okay in a normal efficient market. You would just price it higher, right? That's part of the risk. What we've been surprised at is looking at our lenders, how they don't necessarily treat these differently. Sometimes they move the LTV down a little bit, but the rates aren't any different. We've seen 80% LTV cash out refis in markets that aren't exactly hot at 7.5% being offered in the industry. And that just felt crazy to us. We're not touching those loans. They didn't make sense. So I think to your earlier point about starting to share some takeaways from this data, I think a lot of what can help is basically creating a more efficient pricing model around the industry. So we might actually feel better about those cash out refis because we're getting 12% instead of 7.5%. So we might do it at that point because the numbers start to make sense.
Right.
Early days still here, Mark.
Oh, yeah. No, it's very interesting. And one thing, too, you mentioned, which was like, I'm in Colorado. So our median price in 2011 was $110,000 in Greeley, where I'm at. And right now, our median price is almost $300,000. Wow. So if you look at our dip, none of the deals I do would get you anywhere close to the green if we went down against that dip. And I just wonder, do you stay away from areas like that?
We have, but it tends to be a little more nuanced. The ones that have really fallen, there are three major markets that we all saw in 2008 that really plummeted. It was Detroit, Phoenix, and Vegas. And they all had different reasons. Detroit was more of an economic reason ultimately. And the other two had a lot of sprawl. So it was fairly overbuilt, that sort of thing. But when you get more nuanced, you start looking in Odessa, Texas, and you start realizing a lot of their dips come around oil prices. So what you're also making a bet on is oil prices over the next 10 to 12 months while that loan is repaying. Things like that we feel are too far out of our control, those make us more nervous than really just doing an economic assessment of saying, why did Greeley have this big of a dip? If we don't feel like that condition exists today, we're fine. And you can see things the other way where Austin is above its 2008 peak, far above it, but it's had true economic growth since then. So like everything, there's nuance to it. There's mitigating factors. For Greeley, I can't tell you we've looked at an actual loan there. So I have a feeling we'll run it through our system after this call.
Okay, cool. No, and most of the front range of Colorado has done the exact same thing with prices. And we are 150% or more above our peak in almost all of the front range. So we have just blown past it. And we didn't crash that hard, really. It was just that it has gone crazy since the dip. So it's
Colorado's done very well. Yeah,
yes.
It feels like a lot of Texas has moved up to Colorado. That's
really
a whole lot.
Yep.
Yeah, we've seen a lot of that.
Very cool. It sounds like you guys definitely have your stuff together for picking these loans and deciding, what's a safe investment for you and your investors. So can you tell us more about investing with your company and how that works and what's required?
Yeah, it's pretty straightforward. It's all online. So you just come to alphaflow.com and you sign up. And the one challenging part for some investors that haven't done this online before is just going through what's called accreditation verification. And so typically there's, 12, 13 ways to get accredited, but almost everyone falls into one of two categories. There's an income requirement where the last 2 years you made $200,000 if you're single, $300,000 combined if you're married, and you have a reasonable expectation of doing the same this year. So you really need to show your tax returns for the 2 previous years. The other way is $1 million net worth, not including your primary residence. Now, we've been working with some groups that are trying to get the government to change some of these rules, maybe even add a test function so that if someone can show that they're financially sophisticated outside of these parameters, that they can still qualify. But as of right now, the SEC's got our handcuffs that way. And so that's really what they need to go through. But after then, it's really simple. And you're just uploading docs. Our lawyers basically sign off on everything and you're set. From there, you connect your bank account. If you're with one of the major banks, it's basically instantaneous. And you can start funding your account with as little as $10,000. Within a few days of us receiving the capital, you will have your portfolio starting to get built. And within 2 weeks, we've almost always got your full investment invested. You can see every loan in your portfolio. You can see the health of your loan. One of our big things, Mark, is just transparency. Something I didn't see a lot of around the industry was really being able to understand your portfolio, what's going on, how is it broken up, what are your main states you're in. And so we try and lay all of that out. And so once you've invested, you get to see your loan on really any time. You can see it live, what it looks like. We make continuous payouts throughout the month as the loans pay. We pay it back to you. And a lot of these loans, we talk about them as 10 to 12 month loans. The reality is across the industry, the average actual duration is about 6.5 months. A lot of these guys pay back pretty early. And so the benefit we bring is we continually reinvest that. And so if you're one of our clients, you've got a switch on your dashboard that enables auto reinvest is what we call it, on or off. And you can do that with both return principal and earnings. You can choose how you want to handle each of those. Most of our clients have auto reinvest on for principal, and it's a mix on the interest side of things. So they park $25K with us. They might be pulling out the interest, but we keep that $25K put to work pretty continuously for them. Straightforward, I think. And from a tax perspective, for your accountants, once a year you get a single K1. That's it.
No, it sounds, because I know I was just thinking about this versus the crowdfunding and Realty Shares, and correct me if I'm wrong, but with like a crowdfunding company, you're kind of investing into one deal usually, and you're choosing how much to invest in that deal. And once that deal's over and done, then you've got to find another deal to invest in. Whereas this one, you guys are pretty much investing it nonstop, almost all the time for you.
Yep.
And it's really similar returns. I mean, there's not a big difference there.
No, and one thing that we've seen, and before I officially put it out there, we need to run the full analysis and do the report, but we almost pay for our own 1% fee, if not more, through not letting your money sit around. Through a lot of these platforms, you might look that you're getting 7.5%, 8%, but if your 20% of your capital is sitting around not earning money at any given time, or even more than that with some of these, you've got to take that into account too. So, but yes, going back to what your original question about Realty Shares, and there's plenty others like that, Lending Home, Fund That Flip, Share States, good platforms. We work with some of these guys. You've got to be on there picking your own deals as they come up. You've got to do the due diligence yourself. And we have a lot of clients that like doing that. They just have fun doing that and they enjoy it. And at Realty Shares, I took care of all our clients there. So I got to know a lot of these people, and a lot of them are still investing in equity deals there, but now they do their debt through us because they see they want to be diversified. It's way too much work to be diversified there. It also takes a lot more capital. Typically on crowdfunding platforms, you've got a minimum of $5,000 investment. Some have moved it down to $1,000, but with $10,000, we're still going to put you in 80, 85 different loans. I don't see anything close to that in the industry today.
Right. And that's a very good point. We're being diversified with all those loans. It's much safer than having all your money in one project.
Absolutely.
It could go under.
Yeah. I was going to say, that's really honestly how our industry kicked off. At Realty Shares, our very first clients, they were like you where, they invested hyper locally. They invested in their own neighborhood. Sometimes they were doing the flip, but oftentimes they were the lender, but it was someone down the street from them. So they knew that neighborhood. And what we started to open up, even with a smaller check size and doing the whole loan themselves, was also the ability to invest in other places. I mean, if you live in LA, pretty hard to do a loan in Orlando. Where would you start? How would you find that? And so that's where crowdfunding, I think, opened that up. And that was the first step. I think we just took that next step beyond that of saying, let's just build your whole portfolio for you.
Right. No, that's great. And what about using your IRA or retirement account? Is that possible?
Good question. Yeah, you can invest through your self-directed IRA, SD IRA, and anyone can set that up. It costs about $100. You have custodians you can go to. If you need recommendations on those custodians, our team can help. Just email us at invest@alphaflow.com. We don't get compensated. We can tell you which ones we've had good experiences with and which ones we haven't. But that's a great tool to set that up because it ends up being effectively tax-free. It all stays within there. And we've got a whole lot of clients investing with us through those.
Awesome. Just trying to think. I think those are all the questions I had for you. Is there anything we missed or anything else you want to talk about with this company or comparisons to the crowdfunding world?
I think you've hit on the main ones, Mark. The main things I'd say, though, is if you want to get more familiar, if you're not familiar with this asset class at all, Alphaflow is always great, but I'd say take a look around the industry too. Take a look at Realty Shares, take a look at Share States, Fund That Flip. You don't have to invest, especially with those other guys. You can sign up and take a look, and you can see what these deals are all about. And you can actually see all the information presented and just get more comfortable. Because the one thing we always say is you shouldn't be investing in something that you don't understand at all, that you don't feel comfortable with at all. And so it's great to get comfortable with it. And then once you like the asset class and it makes sense to you, whether it's with one of those guys or if it's with us, that's a better step to take. But it's a good way to get smart around the industry. And of course, you can always call our team. We've got a client services team that talks most clients through this for the first time because most people are new to this. You've got another full-time job. Let us do this for you.
I just have another question. You talked about your research into the different markets and dips and stuff. What do you guys feel about the current markets? I mean, I know we can't predict what's going to happen, but do you have any take on what you see for the future? And I mean, every market's different too, but any insights there? Yeah,
Mark, you hit it right there at the end for us. When people ask me about the real estate market, I sort of don't know how to answer because we're down to a zip code level. And so obviously the things are correlated. When things like 2008 happen, it affects a lot of the economy. But even then, it affected markets very differently. Some were more resilient. And so with our specific role that flips, some of the hottest markets out there, things like LA that people wouldn't think of as about to go under, we've almost completely stopped investing. We barely do any work there because to us it felt overheated and felt closer to, you're talking about the margins where if you're paying too much for a house, it's pretty hard to make that up on the flip. It's just, there's an old saying in real estate, you make your money on the buy. And so what we found is very interesting, probably going through the next year. I'm not trying to pull out the crystal ball and look beyond that, but where we're focusing now is secondary and tertiary markets. So I can tell you we like a whole lot of what's going on in Pittsburgh, in Cleveland, in Columbus, in Orlando, in Charlotte. There are a lot of markets out there that we still find very exciting. Parts of Sacramento. I live in the Bay Area. We barely invest in the Bay Area. It's just the margin is just so tough to make here. If you have any screw-ups, you're losing money, you're in the red. So I like your question. It's hard for me to answer about the market as a whole. I can tell you we try and get pretty nuanced about it, though.
No, that helps a lot. And I just saw on Facebook that a 900 square foot ranch in the Bay Area sold for $2 million. And it wasn't even like in San Francisco. It was outside. I was like, oh man, that's crazy.
It gets absurd. Yeah. I'm not trying to buy more here. To me, it's, if I'm buying, it's outside the city and areas like Greeley I need to look at.
Well, our market, I stopped buying rentals here because it was so expensive, but I'm still flipping. But it's tough. Do you have any insight on rental markets? I'll throw that out there too.
I think we're seeing more of that pop up where even from flippers where these loans are becoming to fix and hold and they're trying to season this and get a renter in there. We've seen, everyone's read the headlines about millennials, but it's a general real trend really of that people are buying less homes. Home ownership is at, 50-year low basically at this point. It's starting to creep back up. You're starting to get more action that way. But the reality is a lot of these markets, renting seems to be a very good place to be. The new tax code, especially in expensive places like California and New York, has incentivized really just not necessarily buying. And a lot of the benefits that were in the old tax code are still there if you're a landlord, because I'll give you an example. If you're a landlord out in California, you've got this cap of $10,000 on the SALT, the state and local taxes. But if you're a landlord, you actually get to take all of that into account. There is no cap because it goes into your net rental income calculation. So it's basically that house is worth more to a landlord than it is to someone living in it. And so we are seeing real trends towards that. I think what we're starting to look at from our clients' perspective is they're saying, look, I'm doing great on your loans. I'd like some of the upside. So I think eventually we're going to look to do rental portfolios or something like that to let people capture some of the upside as well from markets growing too.
Oh, great information. Yeah, the tax code definitely was very favorable to investors, but not so much homeowners with the pass-through deductions too. If you've got that set up right, that can be another huge advantage. Yeah,
so structuring becomes that much more important. And it's tough for some people because it takes a lot of time and money to do the right way. So if we can do that as a larger fund structure, that gets interesting, potentially.
That's a great point. Sure. Awesome. Well, yeah, like I said, I think that's all I had. Great job. Why don't you remind us again the best way to contact you guys if anybody's interested?
Absolutely. Thanks for having me, Mark. You can find us at alphaflow.com. That's ALPHAFLOW. And you can also reach out to us just at invest@alphaflow.com. And you'll reach our client services department. And we tend to get back to you within hours, not days. And there are no dumb questions. Just to let you know, we're here to basically explain the industry, how it all works. If you're on social media, you can always follow us on LinkedIn, on Facebook, or on Twitter at Alphaflow. So thanks so much for having me, Mark.
No, thank you, Ray. Great information. If you ever decide to release some of that information that you guys have collected, let us know so we can get some heads up on that.
Absolutely.
And, Absolutely. Thanks again. Great stuff. And we'll have to keep in touch.
Thank you. All right.